Guys, right now, a lot of people are worried about the dollar, about politics, about the Fed, about whether the system is rigged against them. And when fear creeps in, people start guessing, they start waiting, and they even panic sell. Now, before we go any further, I want to address what a lot of people are actually feeling right now, early in 2026, even if they're not saying it out loud. There's this growing sense that the system is stacked against everyday investors. Now, guys, I've heard this since I've been investing for 30 years. The government prints way too much money, the Fed changes the rules, politicians manipulate outcomes, and that there's insider trading. And when people feel like the game is rigged against them, they do one of two things. They either freeze, or they start making emotional, reactionary decisions, dumping their shares, what ends up being at the worst possible moments, even giving up altogether. Over the past few weeks, markets have felt unsettled. That's a word I would use to talk about it. Stocks have been volatile, moving sharply on headlines, policy comments, and shifting expectations around interest rates. At the same time, you've seen gold explode to record highs. Silver has followed it by surging, and the US dollar has weakened again from recent peaks. Then boom, these precious metals that had propelled investor returns collapsed massively in one single day. Silver alone was down nearly 30%. Trillions of dollars wiped out of these assets, people calling for it to be the market manipulation as big banks looked to cover their shorts. Copper and gold fell north of 2%, and Bitcoin, speaking on a totally different topic, has crashed almost 50% from its all-time highs. Now, what does this tell me? Volatility is high. That scares a ton of people. It's one of the main reasons people sell these assets at the worst times. That's why we're here, to be the voice of reason and remind you about what's really in your control. Here's the truth. You don't need to like the system. In order to successfully invest in it, it doesn't matter what you think of the system. And you definitely don't need to predict macroeconomics to build wealth. You just need to understand incentives and focus on the few things you can actually control. You cannot control fiscal policy. You cannot control interest rates. You cannot control what politicians say or do, but you can control what businesses you own. You can control the price you pay for them and how disciplined you are when emotions run rampant. That is what this video is about. We're not here to guess whether the dollar collapses tomorrow or whether the market crashes next month. We're here to explain what's actually happening beneath the surface and then show you how long-term investors like Buffett and Munger have positioned themselves to avoid the panic, the guessing, and chasing hype. Because once you understand the mechanics of the market, the fear fades. Guys, this is very common. The things you understand that other people don't would not cause any fear for you, would cause immense fear for them. That's the point of what we're trying to do here. We're trying to get you to be more informed about what drives the market in the long run. That way, when there is a lot of fear going on, you're good. For other people, they're fearful, you'll be calm. Now, in a few minutes, I'm going to tell you what I think Trump is planning to do with the dollar. But first, I need to explain what's been going on with the dollar over time. One of the biggest mistakes people make is imagining a currency collapse like it's a movie scene. Banks shutting down overnight. ATMs stop working. The dollar goes to zero over the course of a few short days. But guys, that's not how it works in real life. The US dollar isn't actually crashing in some dramatic headline-grabbing way. It's doing something far more subtle and far more common throughout history than people realize. It's losing purchasing power over time. The dollar doesn't fall off a cliff. It erodes quietly, predictably, mathematically. And that distinction matters because slow erosion is much harder to notice and much easier to ignore. It's why so many people miss why investing is so essential. When people say the dollar is strong, they're usually comparing it to some other currency out there in the short run. But that's not necessarily the right comparison. The question isn't just how the dollar performs against the euro or the yen this week, last month. It's the buying power the dollar provides to you. It's simply math, guys. This isn't a crisis of confidence quite yet. The dollar is still the world's reserve currency. It is still used in global trade. It's still held by central banks all around the world, and it's still the currency people rush to in times of stress. But reserve status doesn't make a currency immune to dilution. It just slows the consequences. And understanding that difference, erosion versus collapse, is the foundation for everything else we're going to talk about today. So guys, let's make this so simple. For those of you who are new to the channel, because this is such an important lesson to understand. Imagine you're in school and the teacher gives out prize tickets for good behavior. At first, there aren't many tickets, so each one is valuable. You can trade 10 tickets for a candy bar. Then one day, the teacher starts handing out tickets like crazy. Everybody has a pile. Everybody gets 1,000 tickets. What happens? The candy bar doesn't magically get better. But if there's a limited amount of candy bars available, now the cost will get bid up even higher. Why? Because everybody has 1,000 tickets. They want a candy bar. Instead of 10 tickets before, now maybe they go 20, 30, 40, 50. Who knows how high it goes? Why is that? Because when you create more of something, each ticket's worth a little less. That's what happens with money. If a company just keeps printing more dollars over time to fund spending, to cover deficits, to stabilize the system, whatever the reason, each individual dollar tends to buy a little bit less in the future. Not overnight, not like a movie, but gradually. And this is why people feel like everything is getting more expensive. It's not that the thing is becoming more valuable. It's the measuring stick, which is the dollar, is shrinking. And here's the key point. This isn't a conspiracy theory. It's not about panic. It's just how fiat currencies work when debt grows faster than income and the money supply expands to keep that system moving. So the right question isn't, is the dollar going to collapse tomorrow? The better question is, if I sit in cash earning nothing for 10 or 20 years, how much purchasing power am I giving up? Now, guys, I want everybody to understand something. I go on Twitter, I go on Instagram, and I see all these people out there saying, the dollar's lost 99.9% of its value. See, shut the fuck up. Yes, we have dilution, we have inflation. It exists. But I don't understand why people have this focus on it, but then they don't focus on the things that matter the most. What are the assets that you can buy that over time, even with that happening, will still make you far more money than your dollar is losing value? The slow bleed does destroy wealth for people who don't own productive assets. Go do research on how many movie tickets you could have bought with a $10 bill in 1950 versus how many you could buy today. Same $10 bill, very different result. Use the example from earlier. How much was a candy bar? Your grandparents, ask them how much a candy bar is. See what they say. This erosion of purchasing power isn't random. It's usually driven by a few big forces that stack on top of each other over time. First, persistent deficits. Guys, what this means is when the U.S. spends more than it brings in year after year, when the spending grows faster than revenue, the gap gets funded with debt. And when debt grows faster than the real economy, you eventually need easier financial conditions just to keep the system from choking. Second, interest expense has become a major problem lately. When we had rates so low and we had tons of debt, it doesn't cost much. But rates skyrocketed, that debt gets refinanced, all of a sudden interest costs are skyrocketing. The cost of servicing all that debt is going to rise as rates stay high. This creates constant pressure for rates to come back down. But when rates come back down, guys, what that is just increasing the money supply. That's all they're doing there. When you put all that money out there, it makes money cheap. That's how they control the rates. And guys, let's be clear and let's be honest. Governments usually choose the option that keeps things moving along, keeps kicking that can down the road. What's easier, to address the problem right now or say, let's just print a few more dollars out there? Now, third issue, global diversification. This one's important. It's not that the world is abandoning the dollar tomorrow. It's that central banks and countries gradually hedge their exposure. They diversify reserves, they buy more real assets like gold, and they reduce reliance on any single currency over time. None of this requires panic. None of this requires a crash. It's just math. Debt compounds, incentives follow, policy responds. And over long periods of time, the currency loses purchasing power. That's why I keep coming back to the exact same point. You don't win by predicting headlines. You don't win by saying, oh man, the dollar's fallen 99.9%. What a scam. Guys, this has been going on for centuries. You win by understanding the incentives underneath all of this and reacting appropriately. Now, let's talk about the part that people get really emotional about, politics and the Fed. But I want to keep this very neutral and very practical. Presidents, regardless of party, tend to want the same things: economic growth, strong markets, cheaper borrowing costs. Why? Because lower interest rates make it easier for consumers to spend, people feel wealthier, businesses invest, and governments don't want to pay that huge debt service cost. It's the financial version of taking your foot off the brake. And when you hear Trump talk about wanting cheaper debt or even wanting a weaker dollar to help trade competitiveness, that's not some shocking secret. That's incentives. A weaker dollar can make U.S. exports much more competitive overseas and can help in a trade war environment. Lower rates also will reduce the pressure of interest payments on a giant national debt load. Now, layer in the Fed. The Federal Reserve has its own mandate: inflation and employment. But the reality is, when debt levels are high, the entire system becomes way more sensitive to interest rates. And if we're not doing something to lower those debt levels, all we're doing is kicking the can down the road. Higher rates don't just slow inflation. They stress consumers, they stress companies, and the government's interest expense means probably higher taxes down the road. So over long periods of time, there's almost always pressure, whether it's spoken or unspoken, for financial conditions to loosen again. You can argue about who's right. You can argue about what should happen, but you can't build wealth by fighting the policy. If leaders are pushing for growth and easier money, assets may continue rising until they don't. And if it all comes down like a sack of cards later, the only thing that'll matter is whether you bought real businesses, and the most important part, at prices that made sense. If this all sounds theoretical, let me ground it in real history, because this has happened before. In the early 80s, the US dollar had become too strong. American exports were expensive, trade deficits were growing, and US manufacturers were getting crushed globally. Does that sound familiar? So 1985, the US didn't panic. It didn't lose control. Instead, it coordinated. The US, Japan, Germany, France, and the UK signed what became known as the Plaza Accord, a deliberate agreement to weaken the US dollar against other major currencies, and it worked. Over the next couple of years, the dollar declined significantly. Here's the key lesson. This wasn't a failure of policy. It was the policy. Governments manage currencies to achieve economic goals. They don't let markets run completely unchecked when trade, debt, or growth are at risk. And when currencies weaken by design, real assets reprice upward. Stocks, commodities, businesses, real estate, anything that produces cash flow. That's why understanding incentives matters way more than reacting to the headlines. The dollar didn't collapse after the Plaza Accord. It adjusted. And investors who owned productive assets came out just fine, often better than before. This isn't new. It's not radical. It's how economic systems have always functioned when imbalance is built. Now, here's where most investors completely misdiagnose the problem. They ask, is the dollar collapsing? That's not the right question. The right question is, what happens to my purchasing power if I sit in cash for years while the system quietly inflates? And when I say sitting in cash, guys, this is part of the reason I get upset with Twitter and Instagram. They assume the money sitting in cash is earning 0%. No. Right now, if you put money in 90-day treasury, you're getting 3.6%. And with inflation in the low to mid threes, you're essentially equaling that power, that change out before taxes. But the biggest wealth transfer doesn't happen during crashes. It happens during long, boring stretches where inflation slowly does the work for you. Cash feels safe. Cash feels stable. But over time, cash loses ground to assets that produce income or grow with the economy. People also assume they need to outsmart the system to survive it. They think they need to perfect timing. They think they need perfect timing. They think they need insider knowledge or some sort of grand macro prediction. That mindset leads to paralysis, waiting for clarity that never ever comes. And finally, people confuse unfair with uninvestable. Yes, policies may benefit some groups more than others. Yes, incentives matter. But stepping out of the game entirely doesn't protect you. It just guarantees that you fall behind. The goal isn't to predict collapse. The goal is to position intelligently inside the reality that already exists out there. Once you start realizing that the world's going to do what it's going to do, market's going to do what it's due, and your job is to sit there and put yourself in the position to benefit from that, life becomes a lot easier. But if you're fighting saying, oh, the market should have done this, just guys, the market doesn't care about you. The market's just going to do what it's going to do. And it starts with owning these productive assets, understanding what you're buying, and refusing to let fear or frustration push you into inaction. And this is where a lot of people sabotage themselves, not by making bad investments, but by waiting for certainty that never arrives. They say things like, I'll invest once rates come down, or I'll buy after the election, or I'll wait until the dollar stabilizes, or once markets become more stable, I will buy. But markets don't send invitations, guys. By the time things feel safe, prices have already adjusted. Guessing macro outcomes is a losing game. You're not going to consistently predict what the Fed does, what politicians say next, or how markets react in the short term. Even professionals, the people that have these Harvard MBAs and all these PhDs, they get it wrong all the time. In fact, far more wrong than they're right. The real mistake isn't being early or late. It's doing nothing. Smart investors don't wait for perfect conditions. They accept uncertainty as the cost of admission and focus on what they can control, which is buying good businesses or the entire market at sensible prices over time. You don't need to go all in. You don't need to time the bottom. You just need to participate intelligently. And guys, sometimes that means buying when things are overpriced like today, because you're getting yourself in the habit of always dollar cost averaging. The market doesn't reward those who wait for clarity. It rewards those who act with discipline while others hesitate. If you're scared of losing money in the market, I know why. You've probably been guessing. And I used to do the exact same thing. I would buy stocks because someone on TV said that they're going to the moon. But that's not investing. That's rolling the dice. And that's exactly why I built Everything Money. First, it was built for me. I wanted the tools that gave me clarity and helped take the fear out of investing. People saw me using them on YouTube and said, Paul, how do I get that software? And I used to joke and say, you can't, it's a big data feed. But then it dawned on me, no, I can make this for other people. So I did. And a real community of people who agreed to grow together was born. Real people sharing ideas, live chats, live streams, and tools that help you be better than 99% of investors out there. I still use these tools every single day, like Stock Analyzer, Real Estate Calculator, and Retirement Calculator. So stop guessing, start learning, try it for $7 for 7 days, and see how your confidence will replace fear. Click the link on your screen or go to everythingmoney.com. Now, this is the part of investing almost nobody wants to hear, but it's where the most real wealth is built. Guys, boring works, and the more and more I've invested, the more and more I realize how true that statement is. Boring businesses don't make the headlines. They don't give you something exciting to talk about at dinner, but they do something far more important. They generate cash, and because they're boring, nobody wants to have them, and therefore their price stays down. Guys, take AutoZone, Ross Stores, or Home Depot, for example. And I'm not just cherry picking 3 companies to say these are it, but these are the 3 of the highest returning investments over recent decades. AutoZone, Ross Stores, Home Depot. Which one of those have AI in them? Think about other companies that quietly built fortunes over decades. Those other home improvement retailers like Lowe's, consumer staples, insurance companies, railroads. None of them felt exciting while the money was being made. They felt slow. They felt predictable. Guys, they were dull. But that boredom is a feature, not a flaw. Guys, I get really moved inside when I talk about this. My best investments are the boring ones. Speculation feels smart in the moment. Boring feels uncomfortable because it doesn't give you some emotional reinforcement. There's no rush. There's no adrenaline, just steady compounding. And here's the irony. The more boring the business and the easier it is to value, the less you need to guess. Most people lose money because they want to be entertained by their portfolio. They want action. They want stories. They want to feel like something is happening. But real investors want the opposite. They want predictability. They want businesses that quietly do their job while the world argues about politics, currencies, and headlines. If you can train yourself to get comfortable owning boring, durable businesses and holding them while everyone else chases excitement, you're already light years ahead of everybody else. And here's the most important truth in all of investing. And it's the one thing you can actually control. You can control what price you pay for an investment. That's it. Price is what you see on the screen. It moves every second. It's driven by emotion, headline, speculation. But value is what a business is actually worth based on the cash it can generate over its lifetime. Those two numbers are often very different, price and value. Most investors make the mistake of anchoring to price. If it's going up, it must be good. If it's going down, something must be wrong. Guys, let me give you guys a great example that just happened. I just tweeted about it today. Intel, NVIDIA. In the last year, Intel is up 153%, NVIDIA is up 43%. I own stock in Intel. I do not own stock in NVIDIA. If you ask me right now, which is the better company? Guys, beyond obvious, NVIDIA is the better company. Now, you're probably hearing that going, wait, he just said NVIDIA is a better company, but he owns Intel stock. And guys, guess what? Intel is up 153%. People look at the returns of companies and say that is what makes it a good company or a bad company. It's not. Guys, Intel is so clearly not nearly as good as NVIDIA. NVIDIA is so much better. But in the last year, Intel has absolutely smoked NVIDIA's return by over 3 times more. How can that be? Well, pricing. If you bought NVIDIA at the wrong price and you buy Intel at the right price, that's what makes it different. That's the thing you can control. And I love when I see people get a text. This is a great example because people hate Intel, yet its stock's up 150%, and people love NVIDIA, and it's only up 40%. But people love NVIDIA because of what it's done in the past. And it is a great company, great balance sheet, great innovation. They dominate the market. I clearly think that. But people follow stock prices, and that's backwards. In the short run, the stock market is a voting machine, driven by fear and excitement. But in the long term, it's a weighing machine. And that weighing machine, the fundamentals always win, but it's also about what price you pay for all that weight behind it. So you look at Intel and you look at NVIDIA. How will they do over the next 10 years? Well, guys, depends. Are you overpaying for NVIDIA by a massive amount versus Intel? These are the things to think about. A great company becomes a bad investment if you pay the wrong price. An average company or a bad company can be a great investment if it's cheap enough. That's why price versus value matters way more than macroeconomics and macro opinion. If the dollar weakens, owning productive businesses protects you. And guys, guess what? If the dollar weakens, it's going to have the same effect on pretty much every company in the stock market. So why even think about it? Who cares? If inflation persists, cash flows will adjust over time. If rates fall or rise, valuation math changes, but math still applies. When you buy a price that's below value, you build in protection against things you cannot predict. When you buy above value, you're betting that the future will be perfect. That discipline is the difference between reacting to the world and letting the world work for you. Now, here's an example. Target has had a very hard, rough couple of years. They saw inventory problems due to theft, consumer pressure, and even some political noise. It has been a headline machine in the worst possible way. But if you actually look under the hood, you're going to see a company with real cash flow and a customer base that remains strong. They operate over 2,000 stores across all 50 states, serving millions of customers. This is a retail giant with over $100 billion in revenue, trying to execute a strong recovery. And here's what turns many investors off. Target shares have done nothing but fall over recent years until now. The company's made a significant move since the most recent bottom, up 35%. But let's step back. Let's ignore the noise and see if Target still looks attractive today. Guys, I own Target shares. Don't ever buy a company because somebody on the internet does it. We're here to teach a process and not to give you fish to eat. But here's my point. If you'd asked me right before this video was being made, what's Target's price? I'd have said 85 or 90. I had no idea it was at 115. I never check my stock prices because if I attach myself to a stock price, I'm going to lose out in the long run. So Target's a $52 billion market cap business. They've got cash flow about $3 billion a year, about the average for the last 5 years. They're selling for 17 times free cash flow. Healthy dividend, 3.9%, but it eats up 2/3 of their cash flow. That's a big number. Return on invested capital is declined in the last year versus the last 5 years. But look at this revenue. This is where there's a lot of potential here. Their revenue growth over the last 3 years has actually been negative. But I like these margins, very consistent margins, 4%. All right, let's see what it looks like from an 8-pillar perspective. Okay, so we've got 5 checks and 3 X's. Net income's down, cash flow's down, even though revenue's up. So to me, this tells me this is probably a temporary problem. They can keep revenue growing, because guess what? They're not making acquisitions. They have to open new stores. They're growing their revenue, but profit and free cash flow are down. I'm not worried about debt, because these debts have to do with like their leases and things like that. Guys, I go through a lot of numbers in these things. And for somebody who's new to the channel, even if you've been around for a while, it can feel overwhelming. You're not alone. It's been overwhelming for every single person in the history of the world at some point. You've got to decide, do you want to have a better understanding, which means less fear, or do you just want to sit there and continue on with this world of fear? Guys, I have all these key metrics here that I focus on, and I don't have a time in this video to go through every single one of them. But the great news is I've created a wonderful cheat sheet for you that'll go through every single key metric here, explain it to you how it's calculated and what it means. If you click the link below, download the PDF, you will get this free PDF. Again, absolutely free, no questions asked. This is why I teach on YouTube, because to me, there's so much out there that is misinformation. But understanding the metrics that actually drive value are so important to me that we make all these PDFs for you guys absolutely free. And in a few minutes, I'm going to put it all together with the story and the numbers to tell you the price that I would pay for this company. So let's go check out analyst estimates before we go further. So they're estimated to make $748 this year, going to $10 in the next 4 years. And then revenue growth declined, but then back up to basically 2 to 4% a year, which makes sense. If we have costs going up 3 or 3.5% a year, products will go up 3 to 3.5% a year. It makes sense their revenue grow along with it. But now we put this all together in the stock analyzer tool, because the most important part is to compare price to value. So let's go to our stock analyzer tool. I'm going to pull up the last time I did Target. Now, guys, I did a 10-year analysis. You can do between 1 and 20 years in our stock analyzer tool. I did 2, 3, and 4% revenue growth for the next 10 years. So nothing insane, nothing too low. I'm assuming they're going to be around, because I look at Target saying, women love it. People still like going to stores. People always like going to stores. Yes, will it shift, but they're doing a good job with online sales. Profit margin, 3, 4, and 5%. Again, nothing insanely high, nothing insanely low, just what I think would be a good range for the company. Now, what is the PE or price of free cash flow that I would apply to this company 10 years from now? Well, guys, it's Target. I think they're a great company that people love. They have good returns on capital over the last 5, 10 years. So I'd start at 15 or 16 in my head, but I go higher for good businesses, lower for bad businesses. I consider Target to be a pretty good business. So I did 17, 20, and 23. Now, you might disagree with me, you might not. That's the whole point of having access to the software yourself. It allows you to make your own assumptions. And finally, my desired return. I do 9% here. This is just basically, what do I think the company is worth? Not necessarily what I buy it at. What do I think it's worth in the market? I hit the analyze button. Guys, I have a low price of 106, a high price of 250, a middle price about 170. Now, keep in mind, the current price returns include the dividends. Don't add the dividend in here. But I look at this going, all right, this makes a lot of sense to me. Now, let's zoom out and put this all together. The dollar isn't collapsing overnight. Markets aren't ending. You don't need to predict what Trump, the Fed, or anyone else does next to build your own wealth. However, money is slowly losing purchasing power, and that will continue probably forever, even if we get debt under control. Now, debt is being managed through time and inflation, and the system rewards people who will own productive assets, not those who sit on the sideline waiting for clarity. So the market falls. You should focus on buying great businesses at even better prices with ample margin of safety and the patience to let time do the heavy lifting. That's how you protect yourself from currency erosion. That's how you stay ahead of inflation. And that's how normal people quietly build wealth while everyone else argues about the headlines. If you do this consistently, boringly, is that even a word? Unemotionally, the market will eventually reward you. And when the markets get noisy, most people panic. We get interested. The recent events may feel uncomfortable, but discomfort is where great opportunities begin. Some of the best investments of a lifetime are made when others are afraid. If you want to understand why that's happening, right now could be the start of a major opportunity. Watch this next video. Click the link on your screen. Thank you for your time.